Nvidia reports Wednesday after the bell, and in this video we're going to be talking about my high five snapshot here, and then we're going to get into the charts a little bit, and we're going to see where Nvidia is telling us with our technical analysis where they're going to go and potentially go after earnings. So let's get into it. So we have my high five snapshot here. If you're new here and you haven't seen this spreadsheet yet, it's essentially how I basically invest. I punch in the companies off of this after doing my due diligence. If I like them based on my due diligence and I like them and we get a buy rating on this sheet and we get a good margin of safety here, then I go ahead and dive into the stock and investment and add it to my investment portfolio. So just running through this real quick, just some basic stuff right here, like the market cap, almost $3.3 trillion market cap. We have a free cash flow margin rate for which is their current free cash flow margin rate of 55% is what they're putting out right now, and I could see that growing to 60% in the last 5 years of this overall 10-year analysis. And basically this is mainly a discounted cash flow model with some other things like free cash flow, forward free cash flow, PE, forward PE, and PEG ratio. So just looking at the meat and potatoes here, 55 and then growing to a 60% free cash flow margin rate with a discounted rate of 10%, like the GOAT Warren Buffett always uses. Terminal value, so basically what are we willing to pay at the end of this 10 years for this free cash flow of Nvidia, and I'm putting that at a 25. I expect them to be doing more than $56.6 billion in free cash flow because that's what they're doing right now. $130 billion in revenue is what they're doing now. $4.4 billion in stock-based compensation based off that $56.6 billion in free cash flow. Net cash to net debt is a net positive of 11 billion. Shares outstanding are 24.5 billion. And then we have our free cash flow yield of about 1.72% and a forward free cash flow yield of about 2.17%. It's good, not great. I like to see over a 3% free cash flow rate, but for a company like Nvidia and everything you're getting with them, the leader in the chip space, I will take around 2% free cash flow margin rate. EPS for this year is supposed to be $3.01, and this is their final quarter of the fiscal year that they're about to report on Wednesday, and then moving up to a forward EPS of $4.51, and then a PE of 45-ish, and a forward PE about 30. Not bad forward PE for a company like Nvidia again. And then our PEG ratio is about 0.33 or 0.40, I guess you could say, with this 137 or 112% revenue growth rate for this current year. So basically getting down to it, the brass tacks, I have a $155 fair value on this company based on a discounted cash flow model, which is essentially a 13% current margin of safety. I like to be buying under 20% current margin of safety, but again, we are having a 25 in here, which you could argue for a 30 terminal value of a PE, and that takes us to about 160 plus. Also, just understand that this is the intrinsic value, the fair value, what the company should be priced at based on their free cash flows, and essentially, you typically never have a company perfectly priced. It's either overvalued, so it can go way over 155, or it's undervalued, which it's currently undervalued because we currently sit at $134 per share. So we have if everything I have on here is pretty accurate with the revenue growth rates, dropping down to, basically low teens, and then also our EPS dropping down to low teens, we're essentially seeing that we have a CAGR, 10-year discounted cash flow CAGR of 17.7%. Remember, the market average, you get 8 to 10%. And dropping down here to an EPS, you are getting 20.2% CAGR over the next 10 years. So an annual CAGR of 20% per year, which those are both really, really good if we nailed the revenue growth, if we nailed the free cash flow. And obviously we don't dip down below 55 and 60, and we stick with these. So we have a triple buy here based on our annual CAGRs for EPS, on our discounted cash flow, and then just overall 155 being the fair value. And if we dip down here, look at the EPS growth rate, nothing crazy here. This is analyst expectations. going from a current 45-ish PE right now, dropping down to 40, then 30, and then 25, and then down to 20, just because, again, we see that these revenue growth rates or EPS growth rates just aren't the greatest. It's not explosive EPS growth rate, and it's not explosive revenue growth rate, but you have the moat and you have the brand. So as you can see, the fair value over the next 10 years with these current PEs and this EPS based on today's price, it's a buy all day. So moving on, let's get into the charts and let's just talk about earnings a little bit. They are expected to report earnings of almost 85 cents per share for this quarter and a revenue growth of $38.08 billion. Now, I actually think they're going to report very good earnings. I actually believe they're going to have a double beat and a guidance raise, actually. And I believe they're going to be talking about Blackwell, the demand for Blackwell, and talking about how everybody, Meta, Google, Microsoft, Amazon, CapEx is exploding. And where do you think that CapEx is going? It's going to Nvidia. It's going in Nvidia's pockets for their chips, and specifically for those Blackwell chips. So I expect them to announce, pretty explosive growth on Nvidia or on the for Blackwell, and just overall, I think they're going to have great earnings, blow it out of the water, and then this consolidation period that we've seen here, I believe that we're going to finally break out of that for good, and we're going to see a big move over the next year for 2025. So if we were looking on this, we got the buy signal based on my high five trading strategy down here. This is the monthly chart, by the way. We got this bullish cross on my high five indicator. We flipped the green. We got the buy price here, or we got the buy signal here, and we have ran and continuously bounced off of my high five indicator multiple times, even recently as now. And obviously you can see here, we have this nice, dip buy box that we came back to, and we just had a nice little, reset. And again, this consolidation here where everybody's sitting here saying, wow, Nvidia has ran so much, it's gotten overpriced. Well, you saw the same thing happen here before we had another rocket ride higher. And I think we are seeing the same thing as we saw here. And we will have another big move as long as Nvidia gets this, has a really good earnings report and guidance. Guidance has been key. So as long as that's good, I think we will move higher and we will break over this all-time high up here at about $152.88. Let's just call it 153. And I believe we'll start making our move to this measured area of $193. Also, you can see that not just on my high five indicator, you could have been able to ride this through the Williams consolidation box, my other trading strategy, where essentially you run up here on the Williams percentage range, you run up, and then you kind of just bounce back and forth in this Williams consolidation box. And as long as you stay within the confines of that box, the stock price will continue to climb higher, and you have no reason to worry. The high five trading strategy, the high five indicator, the Williams consolidation box strategy, and my high five snapshot, my trades, my trade signals, courses, live streams, it's all right here in our high five community if you are interested. So with that being said, again, I think that we are going to see a measured move up to 193 after a double beat and guidance raise on Nvidia. And I do believe that things are looking up, not down for the overall markets. And I do believe we are going to have a parabolic move here into the end of the first half of 2025. If you enjoyed this video, smash that like button, subscribe, follow for more, comment below what else and what other stocks you want to see on the high five snapshot. Thanks guys, have a great day.